AQR's Cliff Asness.
And for the past 25 years, he's been running AQR.
Your paper, the less efficient market hypothesis.
That the crazy periods are getting crazier and lasting longer.
Meaning prices are a little bit more disconnected from reality.
There's a tremendous amount of stock market concentration. How do you invest through that?
We'd run away from this problem.
The main thing we did was stick with our process.
2022 was AQR's best year on record.
You are coming off this record year.
Yeah, there is some vindication in that.
What's the best investment advice you've ever received?
My wife tells me, stop looking at the screen, and she'll be a happier person married to a happier man.
Good morning. Thank you all for joining us for day two. And Cliff, as we were standing there watching that video, it had to have been a little bit of a stroll down memory lane. I mean, 27 years you've been at this.
Some of that was like last Thursday, but some of that was I want a copy of that.
Did you think it would last 27 years when you launched?
I don't think when we launched AQR in '98, that question even came up. I was just 30. We were leaving Goldman Sachs. It was like, can we do this? Can it be successful? Over time, the desire to create something that kind of outlives you, not in everyone, but definitely has grown in me. So now I'm both pretty proud of the 27 years, but also a little sad that that's a long time, and those have occurred already.
So as you've gone through this journey, what has been the biggest change for both the industry and for AQR? You've had to continue to innovate, to stay ahead. What are some of the bigger changes and trends you've had to navigate?
Well, for the industry, I think you guys probably know this, but the rise of passive, the rise of ETFs, the rise of private investing, I wasn't smart enough to see any of that coming. Early on passive, I thought, that Jack Bogle had some pretty good ideas.
Right.
But did I think it would come to not maybe dominate, but to be such a big force? And those things all matter and make for changes. I do think some of the very basic things that drive, call it active management, errors that humans, including me, when I'm not being a professional quant trader, these are just built into our DNA, behavioral biases and whatnot, I don't see them getting a lot better.
Right.
I don't see the world suddenly wising up and being like, we're not going to look at short-term results and assume it goes on forever anymore, or overpaying for story stocks or something. So there are a whole bunch of things that have changed, and some basics that have stayed similar or even gotten a little more extreme. I do have a belief, and I wrote a piece in the Journal of Portfolio Management recently on this, that markets are probably more prone to crazy times, call them bubbles, than before I started my career. A little of that's ex post. AQR began a month before the famous dot-com bubble of the late 90s really took off. I get a little annoyed because I now look at rooms where I see like 2 people who actually remember the dot-com bubble live. Some people who are like, yeah, I think my parents talked about that in junior high. and for some, it's just ancient history, but we cut our teeth on it. And that was measurably, in really quant geek ways, the craziest thing we had seen in markets. And then 20 years later, even pre-COVID, but COVID sent it to the moon, we saw those measures exceeded. So, you asked me about the biggest change. I think markets are more prone to that. I mentioned passive already.
Yeah.
I think that's part of it. I'm not a full-on passive hater. There are people who get up on the stage who'll tell you passive is everything wrong in the world. And my favorite is, I won't name the authors, but there was a Bloomberg piece with the quote, "Passive investing is worse than Marxism." It seems like an odd comparison. I did appreciate the implication that Marxism isn't great. I share that view, but I'm not that. But a world where active managers' their job might be narrowly to make their clients money, but in a societal sense,
right,
their job is for prices to be somewhat near reasonable. That's what a market does. It allocates resources. And fewer people doing it probably leads to some more deviations. Though I'm an old man, and I do think the rise of social media and 24/7 trading with gamified trading, where you get little balloons if you buy and little sad face if you sell at a loss, has probably made our market somewhat less stable. It's made our politics less stable.
Yeah, let's talk about sort of the macro environment. In 27 years, you've seen a lot of geopolitical situations, different macro events. You launched around the time of the Russian debt crisis. You know, we're in a world today that is very uncertain, very complicated when you look at what's happening geopolitically in China, the Ukraine. How do these big global events affect what you do day in and day out?
Okay, well, first, we try and always fail to have them not affect us. As quants, we do some macro investing, we do some trend following, and obviously if you have a macro position, macro events will affect you. But one of the absolute core things we do, probably the single biggest part of our company, is very diversified global long-short stock investing. And if there's a little bit of a tautology or circularity here, if we find we have a systematic bias to do well in one kind of market, or we would try to remove that from the process. But that doesn't mean we get it always right. Right? When things go crazy, if you get it right, you're going to have a bigger result than normal, and if you get it wrong, you're going to have a worse result than normal. In the April swoon, we did not enjoy that one. We enjoy a lot of drops in markets. We mostly try to be market neutral, and most of them work out for us. That was not a fun one, largely because carry strategies got destroyed, and we're believers in the macro world, and you get paid for that. You know, a lot of volatility around China, and we had some positions there. 2022, giant macro event of increasing inflation. I'm not rooting for ill for the world, but in a narrow AQR sense, probably my favorite year ever, because the stock selection that's not supposed to be affected by those wasn't, and just did its normal job, and the macro side got it right. So macro events to us, we don't sit around at AQR and go, what do we think's gonna happen? Is he gonna put new tariffs on? Is he gonna call off the old tariffs? We try to basically insulate ourselves from those with decent but imperfect success over time. I don't think you'll find many quants who sit there and have a, you know, what I'm currently forecasting is this blow up. We do think, though, you talked about uncertainty. We do think everyone has a bias to think the current period is more uncertain than normal. I think if you polled most of us, very rarely would we say, oh, yeah, now we know exactly what's going to happen. With that said, not to be too much of a hypocrite, we do think uncertainty is elevated. You can measure this. I'm a quant geek, so always immediately my first thing is to try to measure things, but we're not the only ones to do this. We build indices of uncertainty. There are things like, what's the average dispersion in forecasts? Not whether people are getting it right or wrong, but what's the average dispersion? Obviously, more dispersion is a time of more uncertainty. What's the average absolute value of misses in forecasts, both economic and company-wise? Absolute value is about uncertainty. It's not direction. You can get it wrong in either direction. If that's higher than normal, it's probably more uncertainty. And so we do think it's elevated. We think we all got a little spoiled. There were 10 years between the GFC and COVID, well, more than 10 years, where there was obviously vol, there was a taper tantrum in there, but it was generally a super calm period. I do think uncertainty is higher than normal, but it's not through the roof. We normally live through, the normal state of the world is there are some pretty uncertain things going on and they matter.
What seems to be a little different this time, though, might be the impact on the US dollar.
Yeah.
You know, during these moments of crisis, the US dollar has usually increased in value. You're seeing a decline. Are we seeing cracks in sort of the US's standard and the dollar as the global reserve currency?
I think very minor ones. I don't think there's, and this is something I talk with the macro team. Again, at AQR, it's not like we're gonna put a giant short the dollar trade on because we had a conversation and think this, but we're market watchers and we're always looking for what risk to hedge. The problem with being a strong believer that the dollar is going to lose its reserve currency status is what's going to take over.
Right.
You know, if places like China and Europe aren't exactly firing on all cylinders with no fiscal problems either. You could be a crypto person, which I'm not, but you can be, and say that's going to take over. But if you say lose the reserve currency, you have to go, okay, where's it going to go? And this is not good news for the world. Hey, we're all a basket case is not the most positive thing I will say on this stage. But when it comes to the fate of the dollar in particular, a lot of countries face this also. It's not unique to the US. But the biggest threat is a very long-term one, is the budget deficit situation. I'm not going to tell you anything you don't know about this. The old Herb Stein line, though, if something can't go on forever, it won't. Right. Completely useless, by the way, of course, but really pithy. I don't think there are very few people, maybe modern monetary theorists, but I think they're witches and warlocks. I think very few people think it can go on forever. I think if you took a poll of all of us 20 years ago and showed us levels for the debt and deficit now and told us this wasn't wartime, this wasn't even a recession, right. I think we all would have said, oh my God, that must be a crisis. And markets and the US has proven us wrong. It's proven it can go on a long time, but I will still die on the hill that it can't go on forever. So I will not sit here and tell you when that reckoning will be or the form it will take. There are various things it could be. It could be an inflationary period where the debt is inflated away. The most extreme is default. I doubt we ever get to that. I think the path of least resistance is inflation. It could be a serious change in taxation and entitlements. I don't think we have the political will for either of those. So that, we will get the political will when it's a crisis. And that's a bit of a tragedy of democracy, is it often takes a crisis to get the political will to fix things.
The other trend during the 27 years.
By the way, I'm not anti-democracy. I want that clear. It can have problems and still be, Churchill said, it's the worst way to govern ourselves except everyone that's ever been tried.
Technology, right? The growth of technology over the past 27 years, your quote recently is saying you've given into the machines.
I hate that quote.
Yeah, what? That's not very encouraging.
I have two very out of context quotes on machine learning. One is a dramatic, and I do say something like this, so it's not made up. It's just not in full context. That I slowed down AQR dramatically on moving into machine learning, AI in general. There is some truth to it. Maybe 5-7 years ago, when by the way, we invested the money into researching it. So it's not like we were like, this ain't gonna work, this is stupid. But we've had a philosophy for many years of combining economic common sense, theory, intuition, call it what you want. What we were doing had to make sense to us and had to work historically. That out of sample is better, real life trading is better, back tests are secondary, but you need evidence that this works and you need to understand why it works. I slowed that down somewhat because machine learning can't do that. Machine learning, you can still have intuition from it, and we think we're particularly good at extracting that. But you have to surrender yourself somewhat to the machine. Because if not, what's the machine doing? If it's doing perfectly obvious, intuitive things that you have thought of already, it's finding patterns that you weren't able to see with simple theory or even the naked eye. So surrender, the word, I'm almost sure I usually use the word partially surrender, and sometimes that word gets dropped. I still have a day job. I'm not just, hearing every day from a disembodied Siri voice. You made 14 basis points today. But partially surrendering to the machines is necessary if ML, and we're using ML in a more mundane but important way just for productivity, like every other firm, coding and writing first drafts. And we're not a college. You're allowed to write the first draft for ChatGPT. We're not going to give you a bad grade for that. You need a human to look at it still. They're not. Maybe one day we'll pass that, but we are not at the stage where you could just go. You will find the computer wrote some strange things. You want to hear a really morbid exercise, which is kind of fun if you have a dark sense of humor? A friend suggested to me in the early days of ChatGPT, ask it to write your obituary.
Oh.
It did a damn good job. Reading it was a little chilling because it felt like it happened, except it got my birthday wrong by 2 days. And you'd think that would be like the easiest thing for, it's got to be all over the place. We use it for that, but we also use it to generate quant signals. For years, we've tried to use something called fundamental momentum. Are things getting better from the ground up in a company, not just price momentum? For years, quants have tried to process things like earnings calls to see if there's good news or bad news in there. We did it with word counts. If you see the word increasing, +1,
right,
and you have a giant lexicon you build up over time, more complicated phrases, different weights on them, but that's basically what you're doing. But I'm sure everyone in the room sees the problem. If the actual sentence was, unfortunately, massive embezzlement has been increasing, +1 is probably not good fundamental momentum. Turns out we have a massive amount of data, which is often necessary for machine learning, and training it on actual performance of the stock, earnings calls and that.
Right.
Language is inherently nonlinear. It's inherently, this sentence might modify 10 sentences later, and it's just way better than our old methods, and it's been a very successful signal for us. We're using it to allocate amongst our signals. Some of my job has been taken, turning myself partially over to the machine. It used to be mine and a few other senior people's job at AQR to say we have all these signals we believe in,
right,
what are the proper weights amongst them? And we look at theory, we look at correlations, we look at backtest and real life performance. Turns out the machines, they're not way better than me, but I'm John Henry, and the steam thing beats me.
So as yours.
Wait, John Henry died at the end of that, so this is like the most morbid talk I've given in forever. That would be if ChatGPT had me dying in battle with a steam engine, that would be cool.
They'll get the date right.
Yeah.
So as you're working through strategy innovation, you're changing how you invest, what's the communication like with your investors and the LPs? Like what are you hearing from that community as they're trying to assess both your evolution and what's happening across the industry?
This one, I'm going to brag a little. One thing AQR has always been is a high disclosure firm. Not full disclosure. If we think we're the only ones to have figured out some source of alpha, maybe you tell clients in a closed door if you are pretty sure they're not quants who are going to go replicate it, but you don't write a paper on it, and we write a lot of papers. All the way to modifications that are kind of obvious, but we think could be a little better in a very high capacity. And then you're public about it. But we are at for quants in particular, again, there are things we would not share, but I think we're at the extreme end of sharing. We've been accused of oversharing on occasion. I've had, when I've said, the funniest thing I ever heard from a client was when I offered to take them through the whole model, soup to nuts, they said, is that an offer or a threat? Which I just thought was a great line. But we try to keep our clients informed. Most of the time, I will say it's a positive. If we think we've made something better, it's a stacked deck. They've invested with us because they think we're some degree good at this.
Right.
So if we think we've made it better, more often than not, they're going to agree. But every once in a while, a client says, no, you're drifting away from what we thought. We don't want this ML. We want a more steady exposure to the old factors. And there we'll either do a different investment product for them, usually at a lower fee because they're not getting our current whatever, but we'll break out what they want. Or sometimes even with friends, you part ways. But we try to be as full disclosure as we can, and I think we may be close to pack leaders on this. Not all the way, and then let the chips fall where they may. We're doing it because we think we're making it better, and our interests are aligned.
I want to focus on two of the bigger trends we're seeing across the industry. The first is, and AQR was a leader here, is expanding the investor base to include more retail. Right? Historically, alternatives are very focused on the institutional market. You're now seeing a major switch expansion to more retail products, registered funds. It's a big focus in Washington around democratization of alternatives. How have you approached that evolution, because you were an early mover on having both of these products, and what do you foresee for markets as alternatives move more into the retail space? All right,
this is going to be, which is a tough competition, my most obnoxious answer, because I'm all for our democratization and I'm somewhat cynical about some others' democratization. Not nice. Democratization often means, well, the little guy should get to pay really high fees too. How dare you exclude them from that? And what we did, which was, I think, kind of 2007-ish maybe, when we moved into doing some mutual funds, was mostly, almost entirely, about taking something we've been doing for a while. We wrote a whole set of papers, quote, demystifying hedge fund returns, saying, well, merger arbitrage is a great strategy, but if you do every single deal in a diversified way and charge a lower fee, you do a little better than the merger arbitrage indices. It's mainly about an insurance premium you get for participating, not about deal selection. Therefore, we should have a fund that does that at a lower fee. It's good for us, we raise more assets, and good for the client. I do think, and this is where it gets mean, I think some of the democratization today is about taking illiquid assets that perhaps, and we can argue about this, fit in an institutional portfolio and putting them in somewhat more liquid vehicles. Now they play around with how much they're going to put in there, how often they're going to price it, but that's historically a red flag. When the liquidity of the assets doesn't match the liquidity of the investors' terms, you can have problems. I know much of the room will be private investors, and I get yelled at. I'm a private investor. I'm not that cynical that I think no one's good at it. They have sources of alpha I can only dream about. They can make a company better. I'm long 1,000 companies and short 1,000 companies. I have no ability to visit all the longs, no idea what to do if I did, and if I visited the shorts, they'd tar and feather me. They have a lot of things they can do, but I do think the illiquidity in privates that 30, 40 years ago, David Swenson Pioneer days, was a bug. And his book talks about the illiquidity premium. You get paid for buying things other people are scared of, and we have made 5% more a year because we're willing to buy that. I do think that bug has directionally, I don't know if it's fully flipped, turned into a feature where people like not having to mark to market. Hell, I love that. If you look at AQR's return since inception, you're very happy if you just close your eyes and look at the two ends. There have been times you've really not liked me. And if we were marking at a weighted 7-year average of our returns, we had a very happy, I'm in better physical shape if that happened. The rigors of the market, I'm only 29 years old. This is what happens from running a liquid mark-to-market strategy that's good but not perfect. So I do think there is a danger that people are now overpaying for what is a feature instead of getting paid for what is a bug. And if that's right, the stage, hey, let's bring that to retail, might also just be poorly timed.
We've seen the growth in the number of private companies. Companies are staying private a lot longer. Is there an argument that the general investing public should have more access to those private companies that are not going public?
Yeah, there's an argument. A net, I'll tell you, I don't find it an overwhelming argument, but it is true the number of companies that stay private is bigger. They are mostly smaller companies. We still have a lot of large caps do go public. There are exceptions. There are large cap, Coke Industries. There are giant companies that are private. But the change is actually smaller. When people quote the number of private against the number of public, it's exaggerating it because there are a lot of small and even micro caps. It reduces our universe in the public world a little bit, but we never traded those a ton to begin with. So I'll give partial credit for that one. Yeah, theory says you should own a little of everything.
Right.
And then you can active manage around that, but that should be your starting point. Though again, if the terms are unfair, you could throw theory out the window.
Sure.
Even if you should own some of this, if the net fee, when you add it all up, is 6 and 20 on marks, not on realizations, it could still be a bad idea. I'm sorry if I'm pissing off all the private people in the room.
So the data that we've seen where the number of public companies has gone from 8,000 to 4,000, Wilshire, 3,000, actually, whatever the number is, does that concern you as a quant investor in terms of the pool of eligible securities to trade?
Not yet. We tend to trade the top maybe 4,000 or 5,000 in the world, not just the US. I think your numbers are the US. So our cutoff on liquidity and size already meant we weren't playing in most of those. though we are interested in building more microcap products, there are a lot of inefficiencies there. And if we do that, we'll have to be very careful to make sure our back test doesn't overstate things, because if there are half the stocks in there,
Right.
Even if those aren't cherry-picked, you can have two worries. You lose breadth, and a quant wants breadth. We don't know anything about an individual company. We want to make a lot of small bets, and based on these average characteristics paying off over time. So if you lose half your breadth, you might still have a good product, but it's not as good. The bigger worry, which I don't even know how to sign, is selection bias. Is this type of stocks you used to make money on are the ones who are no longer going public. I don't even know how to think about that, but there are two possible issues. If you are trying to do a quant, small, and microcap product, losing breadth, and if there is some bias to hurt your process in particular by removing the longs or the shorts that you use. Shorts won't get removed because the private world is a long world, not a short world. But on the long side, if they're particularly good at figuring out which ones to keep private, it could mean it's not just a smaller pond, but the pond could be a little worse.
So as we wrap here, you are a prolific innovator, thinker. You're always putting out new pieces for people to read, think about. I mentioned to you my favorite, which was the when to pull the goalie in the hockey game when you're losing.
It's really annoying that my most popular paper ever is one of the only ones I've written outside of my field.
Maybe there's something for the Knicks.
Like this
maybe,
finance
maybe
stuff
there's
is
like
boring.
a data analytics piece around the Knicks.
Yeah,
and
keep
like
the turnovers under 20 and you win.
But what's coming? Any coming previews for the audience in terms of what you're working on and what we might expect to see?
I'll tell you my latest I just wrote. I never know the next one because, as people at AQR say, the next one will be whatever angers you next week. And I've never been good at forecasting that. But I just wrote kind of a fun piece. I submitted a paper to the Financial Analyst Journal 26 years ago in 1999. And it was rejected. By the way, this still happens to me. Don't think you attain a certain stature and they just accept happens less, maybe because of some, thumb on the scale, because I've got more of a rep, maybe because I'm better at writing, I don't know. But rejections happen. This was, the famous stat, and in my blog, I'm, again, kind of rude, because I have links to 8 different major money managers who do this study. You know the famous stat, what if you miss the 10 best days for the market, you shouldn't time the market because it destroys all your returns? I've hated that stat for at least 26 years. And I'll give you the blog in a second. It turns out that if you miss the 10 worst days, it had an equal and opposite positive effect. The second, which they never tell you, you could put the exact same study out, not show them the other one, show them yours, what if you miss the worst days, and see, you gotta time the market. Look at how much you can make. Second, it's a ridiculously extreme strategy, right? Let me say it to you another way. If 10 times over a 30-year investment period, you went from 100% stocks, which you are every other day, to 0% stocks, and those were the 10 worst possible times to do that, then that would be bad. That is not a particularly realistic strategy. I do say in there, you probably shouldn't time the market because, like me, you probably suck at it. And that's a pretty good reason not to do something. So I really hope it's not a pro-market timing piece. But if you think you're good at it, which you should, examine, talk to your higher power, try to decide, why am I really good at this? But if you think you're good at it, you should do it proportional to how much skill you think you have at it, like you should do any other symmetric investment strategy. So it just drives me crazy when I've finally taken my revenge. The thing is a fun piece because I have a little intro where I say, by the way, I've not changed a thing in what I'm about. I then present the actual piece I submitted that got rejected in '99. It was rejected, by the way, not because it was wrong. It was rejected because, quote, everybody knows this. So I have spent the last 26 years, I know the editor well, occasionally sending him these ads saying, oh, everyone knows this, huh? But then I have the actual piece, and I'm a little hypersensitive about it because I do think I write better or have better editors at AQR to help me because I read it, and you read something you wrote 26 years ago, you will cringe. You will be like, oh, I can't believe I exaggerated that. I left that. In my abstract introducing it, I had 3 main points. I forgot to do one. I did 1 and 3. I never got to 2. So I do make fun of it and say I'm presenting it warts and all, but it was right, and people should not time the market, but they should also stop with this silliness. So next week, something else will upset me, and it'll be a new one.
Well, we look forward to it. And Cliff, thank you for joining us today. We very much appreciate your time.
Thank you,
Thoughts?
Brian. This was great.
Thank you.